Now, for more on the opportunities and risks in commercial real estate lending, we're going to bring in Byrne, Benefit Street Partners President and Chairman and CEO of Franklin BSP Realty Trust. The one question Alan wouldn't seem to quite answer there specifically, which I'm hoping you'll help do for me, is the cost of capital rising. This reality that borrowers may still face higher costs of capital, whether you're in real estate or corporate America, for a long time. What does the math look like there?
Well, first of all, Sonali, thanks for having me. Yeah, this is the biggest topic around right now. There was, I would almost call it a trifecta of things that happened, all bad, to commercial real estate, and specifically commercial real estate lending. First of all, obviously rates went up so quickly and so dramatically. That put more pressure on the borrowers, and it also made properties worth less. Cap rates go up, they're directly tied to interest rates, hence property values are lower. Two, there's office. We talked about it, I'm sure we're going to talk about it some more, but I think that office story gets worse. It hasn't, that story isn't over yet. It's still sort of playing out over the next several quarters. And what that's led to is, I'll quote Steve Roth at Vornado, who on their earnings call, I think last week, called it a lender's embargo. The banks aren't lending. A lot of the alternative capital providers, mortgage REITs, private lenders aren't lending. Why? Because a third of their portfolios are stuck in stuff that's worth less, specifically office, which is like 30% of their books.
One element of this that seems even more concerning is the broadening of the risk here, the broadening of the pain. You recently told investors that maybe you guys would really skirt a lot of the pain in multifamily, but I'm wondering if you'll speak to some of the pain you're starting to see there.
So let's talk about the first risk in addressing that, the first leg of the stool that went down, which was interest rates. What does it mean? Well, with a dramatic rise in interest rates, real estate values are worth less. Let's just say for a multifamily property, a well-located, it's not a property-specific problem. It's sort of like good companies, bad balance sheet. Property's probably worth 20% less, post-interest rate rise than it was before. Maybe it's, for better property, 15, maybe for a weaker one, a little bit more. So that means if we're a lender and we lent at a 67% loan to value, which is about average for us, on a floating rate loan for a transitional loan, that loan to value today, mark to market, is probably in the 80s, maybe 90, 95%. So the margin for error on that loan is very low. The true-up point, though, when you talk about what's the distress, is most of these borrowers have hedges in place. They have rate caps. They're not struggling from higher rates, but those rate caps go away at maturity. They're coterminous with maturity, right? So when the maturity comes, something's got to give.
You wonder how much the Fed is worried about this problem, because you have such a strong economy. The labor market has not cracked meaningfully yet. So if you look at the stresses in the regional banking system, in the banking system, in the real estate market, how much of a broader problem could that create for the economy?
I think it will, but I don't think the problem is in multifamily. I mean, sure, there's always better properties and weaker properties. I think Sunbelt recent construction is just Class A stuff, is always going to do well. And most of those properties are in the money. The equity's probably still worth something. Rates come down. The equity holder is making a bet. Lenders probably aren't going to lose much money, if any. Office is the problem. As I said before, we still haven't seen that story play out. Why? You're going to have to re-tenant buildings. That's very expensive. That lender embargo, where's the money going to come from to finance, the movement of a property from one owner to another? That stuff's going to take time. We need rates to come down, and ultimately we need to see the benefits of the lack of construction, shrink supply, bad properties coming off the market, and then ultimately that's where the recovery will come from. But in the near term, with all the maturities coming up, that's where the pain's going to be taken.
Interesting. You even look at the expectations from the market for a rate cut in June or July, and it's still kind of a flip of a coin here. When you're sitting where you're sitting, how does that equation play out? Do you think that we'll see that cut materialize, or do you think that rates will stay higher for longer?
So we're not macroeconomists. We really invest on a micro basis. Our thesis, and I'll tell you why, is, I know it's been said here many times, higher for longer. We're assuming that inflation's still going to be sticky above that 2% target. The economy is great. I mean, it's surprisingly resilient. And the Fed has all but flat out told us by, the way they foreshadowed that, expect perhaps rate cuts, data dependent, but don't expect them right away. And I think anybody that's has bet on later rather than sooner has generally been a winning bet. So, from our perspective, rates will come down. Just don't expect that relief valve to occur like in the next quarter or two. It might take longer.